What if the internet could finally offer true, unshakable trust, automatically, without needing a middleman? Or imagine a world where your identity is truly yours and every product's journey is perfectly transparent right from its source. Welcome to the Deep Dive. Today, we're plunging into the profound transformation reshaping our digital landscape, blockchain and cryptocurrency in 2025. And look, this isn't about speculative crypto trading, all right? It's about the foundational technology that's quietly redefining industries, everything from finance to food safety. Our mission for you today is basically a shortcut to getting properly informed. We'll unpack the cutting-edge technological breakthroughs, reveal some surprising real-world applications already generating immense value, and yet dissect the rapidly evolving market and regulatory environment. You'll walk away with a clear understanding of where this digital revolution stands right now and, crucially, what it means for businesses and, well, individuals like you.
We're drawing our insights from a strategic report analyzing the 2025 blockchain and cryptocurrency landscape. It's a comprehensive analysis that really cuts through the hype to give us a clear picture of tangible opportunities. So this deep dive will extract the most important nuggets of knowledge and insight tailored just for you. Okay, let's unpack this then. When we talk about blockchain maturing, what does that really mean? It sounds like it's no longer just about Bitcoin or the early stuff.
Precisely. That's the perfect starting point. If we connect this to the bigger picture, the entire architecture of blockchain is being reimagined. Those early designs, what we often call monolithic blockchains, they had inherent limitations. They often forced trade-offs in what's known as the blockchain trilemma, trying to balance security, scalability, and decentralization all at once.
Right. You could usually only get 2 out of 3, effectively.
Exactly. The current era is defined by a fundamental re-architecture trying to solve that. These early monolithic chains, think like the first versions of Ethereum, they bundled all the core functions, execution, data availability, consensus, settlement, all onto one single layer. And, well, that bundling created bottlenecks, performance issues, high fees.
Yeah, we've all felt that pain.
So the current era is defined by this fundamental re-architecture. It's moving towards what are called modular blockchains.
Modular. Okay, break that down, like building blocks.
Kind of, yeah. Think of it like swapping a single overworked factory for a highly specialized assembly line. Instead of one layer trying to do everything, modularity decouples these functions into specialized independent layers. Each one is optimized for its specific task.
Okay, so specialized layers, what are they?
Well, first you have an execution layer. This is where the smart contracts actually run, where transactions are computed. Separating this allows for a highly specialized environment. So imagine a gaming platform needing crazy high transaction speeds, or maybe a complex financial system needing specific calculation rules. They can have their own optimized execution layer.
Ah, so tailored performance for the application. Got it.
Then there's the data availability layer. Its sole job, really, is to store transaction data and guarantee that anyone can access it for verification. Super important for transparency and auditing. A huge milestone here was Celestia's launch in late 2023. It was the first dedicated modular data availability network. Think of it as providing this reliable, scalable storage foundation.
Right, ensuring the data is actually there, improvable.
Exactly. And finally, you have the consensus and settlement layers. These provide the ultimate security and finality for all the transactions. They're the bedrock. And this is where things like shared security, pioneered by projects like EigenLayer, become really interesting.
Shared security, how does that work?
It allows new protocols to essentially rent security from established, highly secure networks like Ethereum. Instead of trying to build their own massive validator network from scratch, which is incredibly expensive and difficult, they can leverage Ethereum's security. They do this by enabling ETH holders to restake their ETH to secure these new modular services. It massively lowers the barrier to launching new secure protocols.
It sounds incredibly efficient. So what does this modularity mean for businesses and for innovation then? It seems like it radically changes the cost and complexity of building on blockchain.
Oh, the implications are profound. This shift effectively commoditizes the base layers of the blockchain stack. Think about the analogy to cloud computing, right? AWS, Azure. Before them, launching software meant huge upfront investment in physical servers.
Right, buying racks and racks of hardware.
Exactly. Cloud computing commoditized that. You just rent what you need. Now, modularity is doing something similar for blockchain infrastructure. Launching a secure blockchain used to be this monumental task. Now, developers can pick and choose best-in-class components.
Like a tech Lego set.
Pretty much. A startup could launch a new execution layer, use Celestia for data availability, and then basically rent Ethereum security via EigenLayer. This drastically cuts cost, time, complexity. It shifts value creation up the stack away from just building the base layer towards the application layer. And that, well, that fosters this explosion of innovation we're starting to see.
That analogy makes perfect sense. Okay, so modularity is the big architectural shift, but we still hear a ton about layer 2 scaling solutions. How do they fit in? Are they like a stopgap or complementary?
Definitely complementary. Modularity is foundational, reshaping the core. But layer 2 solutions, or L2s, are pragmatic, immediate answers to scaling existing big chains, especially Ethereum. I mean, Ethereum's base layer can still only handle, what, 15 to 30 transactions per second? That's not enough for mainstream use.
Not even close.
So L2s give us that immediate boost in speed and reduction in cost that's just crucial right now.
How do they actually work then, technically?
Okay, so think of L2s as protocols built on top of a base blockchain, the layer 1. They work by processing transactions off the main chain much more efficiently. Then they bundle up hundreds, even thousands of these transactions into compressed summaries or proofs, and those get posted back to the layer 1. The clever part is they inherit the security of the underlying layer 1, but they can achieve speeds of thousands of transactions per second.
Okay, so off-chain execution, on-chain security, what are the main types?
The two big categories right now are optimistic rollups and zero-knowledge rollups, or ZK rollups.
Optimistic and ZK.
Yeah. Optimistic rollups, like Arbitrum and Optimism, are, well, optimistic. They assume transactions are valid when they post the summary to L1. There's a challenge period, usually about 7 days, where anyone can submit a fraud proof if they spot an invalid transaction. They're known for high throughput and being very compatible with Ethereum's code, the EVM, which makes it easy for apps to move over.
Okay, so trust but verify with a time window. What about ZK?
ZK rollups use more advanced cryptography. Think ZK Sync era, Starknet, Polygon's ZK EVM. Instead of a challenge period, they generate a validity proof, a type of zero-knowledge proof for every single batch of transactions. This proof mathematically guarantees every transaction in the batch was valid without revealing the underlying data. The layer 1 just needs to verify this small proof.
So mathematical proof, not just an assumption.
Exactly. This gives them higher security guarantees and much faster finality. We're talking minutes, not days, because there's no long challenge period needed. And Polygon's ZK EVM was a big deal because it managed to combine that ZK security with strong EVM compatibility, which was a major hurdle.
That's a huge amount of technical progress for speed and cost.
Yeah.
But you mentioned something earlier about L2 token prices. Not quite reflecting this progress. What's happening in the market and what new problems has all this L2 success created?
Yeah, it's a fascinating dynamic. Despite these really strong fundamentals, massive developer activity, huge improvements in user experience, the actual token prices for major L2s, Polygon, Arbitrum, Optimism, Immutable X, they saw pretty big corrections in 2025, like over 60% down from their yearly highs.
So the tech is working, but the market's not rewarding it in the short term.
It seems that way. It really raises the question. Is the market decoupling short-term speculation from long-term technological value? Maybe we're entering a more mature phase where the hype cycle is less dominant for these infrastructure plays. But ironically, the success of L2s has created a new challenge: fragmentation.
Yeah. Fragmentation, how so?
Well, the L2 ecosystem isn't one single scaling solution anymore. It's become this fragmented landscape of competing platforms. You've got Arbitrum, Optimism, Base, C-Sync, each building its own vibrant ecosystem with its own apps, users, liquidity. Assets get siloed on these different L2s. Moving your funds or data between them isn't easy. It usually requires using these bridges.
Right, the cross-chain bridges. I've heard they can be risky.
Extremely risky, unfortunately. We've seen over, $1.28 billion lost in bridge exploits between 2021 and 2024. It's a major security headache. So effectively, these L2s have become like digital nation states, each with its own little economy. And that makes interoperability, getting them to talk to each other smoothly and securely, absolutely critical. It's the next big hurdle.
Digital nation states. It's a powerful visual. And speaking of zero-knowledge proofs, you mentioned them being core to ZK rollups. But it sounds like their application is much broader than just scaling. How are they really changing the game, especially around privacy?
Oh, absolutely. ZKPs are genuinely a game changer for both privacy and efficiency. The core idea is pretty mind-bending. They let you prove a statement is true without revealing any information beyond the fact that it is true.
Like proving you're old enough to buy something without showing your actual birth date.
Exactly like that. Or maybe a bank proving it meets reserve requirements without revealing its specific holdings. That's the power. It's fundamentally redefining how we handle privacy and establish trust digitally. And while they're key to ZK rollups for scaling, their applications are exploding elsewhere. In privacy-preserving finance, for instance, ZKPs can shield transaction details on public chains who sent what to whom. This is vital for businesses. We saw Visa testing ZK-based auto payments on Ethereum. Imagine confidential recurring payments without leaking sensitive financial data.
That would be huge for enterprise adoption.
Definitely. Then there's decentralized identity, SSI. ZKPs are basically the engine making SSI work. You can prove specific things about yourself. I'm over 18, I have a medical license, without handing over all your underlying personal data. It minimizes exposure, cuts identity theft risk.
Giving control back to the user.
Precisely. And think about secure and anonymous voting. Governments are looking at ZKPs for remote voting systems where every vote is verifiable, but the voter remains anonymous. Estonia has already run pilots. Or for businesses, again, confidential regulatory compliance. That bank example, proving compliance without disclosing proprietary strategy. It's a massive unlock.
This sounds incredibly versatile. Given these varied applications, are there different kinds of ZKPs?
Yeah.
And what are the trade-offs businesses need to weigh up?
That's a critical distinction, yes. The two main families you hear about are Zk snarks and Zk starks. And choosing between them involves some key strategic trade-offs. The source material lays this out well.
Snarks and starks. Okay, what's the difference?
So, Zk snarks, succinct non-interactive argument of knowledge, are known for having really small proof sizes. Tiny, which means lower costs for storing them on chain, and verification is usually very fast. The downsides: generating the proof itself can be slower, and crucially, they require this initial trusted setup ceremony. If that setup gets compromised, well, the security of the whole system could be undermined. Plus, current snarks are potentially vulnerable to quantum computers.
Okay, small and fast to verify, but trusted setup and quantum risks. What about starks?
Starks, scalable transparent argument of knowledge, produce larger proofs, meaning higher on-chain costs. But proof generation can be much faster, especially for really complex computations. Critically, starks don't require a trusted setup. They're transparent, and a huge advantage. They are considered resistant to quantum computers, so the choice depends on your priorities. Need minimal on-chain costs for something like payments, maybe snarks. Need transparency, quantum resistance, or proof for massive computations. Starks might be better.
Wow, so the choice itself is a serious strategic decision for businesses, not just a technical detail. But you hinted at something even bigger with ZKPs, something about verifiable computation for any program. That sounds potentially revolutionary.
It really is heading in that direction. Beyond privacy and scaling, ZKPs are enabling this new paradigm of verifiable computation. We're seeing the development of general-purpose ZK virtual machines, VKVMs, like RISC-0. These allow you to generate a proof for the correct execution of any arbitrary computer program.
Any program, like a complex AI model or something.
Exactly. Imagine a company running its proprietary machine learning model for, say, financial forecasting. They run it off-chain, privately. Then, using a ZKVM, they generate a ZKP that mathematically proves the model ran correctly and produced a specific output. They can share this proof with regulators, auditors, partners, whoever needs to verify the result's integrity without revealing the secret sauce, the algorithm itself, or the sensitive input data.
Whoa, so you can trust the result without seeing the process or the raw data.
Precisely. It transforms the blockchain from just a ledger into this global, trust-minimized verification layer for any kind of digital computation. The implications are huge. Better IP protection, secure data collaboration between competitors maybe, automated auditing. It fundamentally changes how we establish trust in complex digital operations.
That's truly mind-bending. Okay, let's bring it back down to earth slightly. With all these new chains, L2s, specialized functions popping up, how do they all talk to each other? You mentioned the digital nation-states problem with L2s. Interoperability seems like it must be a massive challenge.
You're absolutely right. That explosive growth has created a powerful but incredibly fragmented digital landscape. Each blockchain, each L2, often operates in its own silo. This fragmentation seriously hinders network effects, makes the user experience clunky, and it's a major bottleneck for wider adoption.
Oh, how do we connect these blockchain islands?
The goal is to create this internet of blockchains, right? Seamless communication and value transfer between independent networks. There are several approaches being worked on. The most common today, but also the riskiest, as we discussed, are cross-chain bridges. They usually work by locking an asset on chain A and minting a synthetic wrapped version on chain B. Functional, yes, but prime targets for hackers. That $1.28 billion figure speaks for itself.
Yeah, clearly not the ideal long-term solution. What else?
More advanced are generic messaging protocols. Think of projects like Layer 0 or the Inter-Blockchain Communication (IBC) protocol, which is big in the Cosmos ecosystem. These aren't just for sending tokens, they allow for the transfer of arbitrary data and messages. So a smart contract on one chain could call a function on another chain. It enables much richer cross-chain interactions. And they're gaining traction. IBC connects over 100 chains, Layer 0 nearly as many, and Layer 0 is even collaborating with Google Cloud as an oracle, which shows mainstream tech getting involved.
Okay, messaging layers sound more robust. Any other models?
Yeah, there are also hub-and-spoke architectures. Cosmos with IBC is one example, Polkadot is another. They have a central hub, or relay chain, that provides shared security and acts as a communication router for a network of specialized application-specific blockchains zones in Cosmos, parachains, and Polkadot. This model is inherently designed for interoperability within its ecosystem.
So what does this all mean for you, the listener, as someone navigating this rapidly evolving digital economy? Why is interoperability so important beyond just fixing the tech headaches?
Well, the real power is that interoperability unlocks the full potential of this multi-chain world. It lets dApps tap into features, users, and liquidity across many networks at once. Imagine moving your digital identity, your game items, your assets seamlessly between different platforms without friction or worrying about security risks. That's the goal. It creates a much more unified Web3 experience. It also boosts resilience. If one network gets congested or has issues, activity can potentially be routed through others.
And are big players taking this seriously?
Absolutely. Look at JP Morgan. They're actively experimenting with cross-chain atomic settlement of tokenized assets using Chainlink's protocol. They know that for global finance, operating across different specialized chains is essential. So interoperability isn't just a nice-to-have technical fix. It's a fundamental requirement for building a truly connected, efficient, and scalable digital economy.
So we've covered the incredible technological advancements, the foundational shifts from monolithic to modular, the L2 scaling, the power of ZKPs, the quest for interoperability. It's a lot. But what does this look like in the real world? How are businesses actually using this stuff today beyond the hype?
Right. This is where it gets really exciting because the theory is hitting the pavement, generating real, tangible value across core parts of the global economy. We're moving past experiments into integrated value-generating solutions. And one of the absolute biggest developments is the tokenization of real-world assets, or RWAs. This is potentially the most powerful bridge being built between the massive traditional financial system and this new digital economy.
RWA tokenization. We hear that term a lot. What exactly is it?
Simply put, it's creating a digital token on a blockchain that represents ownership of a real-world asset. That could be tangible things like real estate, art, commodities, or intangible things like bonds, private equity, even carbon credits. And the key thing is this isn't some future pipe dream. It's happening at scale right now, often driven by the world's biggest financial institutions.
Okay, how does that work in practice? How do you tokenize, say, a building?
Well, it's a process. First, there's asset selection and legal structuring. You need to legally link the token to the actual asset, often using things like special purpose vehicles or trusts. Then, digital representation. You mint the token on a chosen blockchain, maybe an ERC20 token if it's divisible like shares in a building, or an ERC721 if it's a unique asset like a piece of art. Next, smart contract implementation. You embed the rules, how tokens are issued, transferred, maybe dividend payments, compliance checks, right into the token's code. And finally, custody and verification. The physical asset needs secure custody, and there needs to be proof, often through audits, that the token actually represents the underlying asset.
Seems complex, but the validation from big players must be significant.
Hugely significant. Look at BlackRock, the world's largest asset manager. They launched their BUIDL fund on Ethereum, tokenizing U.S. treasuries. It raised over $240 million pretty quickly. Or HSBC, they've launched tokenized gold trading for their clients, allowing 247 settlement. These aren't small experiments. It shows RWA tokenization becoming a core strategic element for global finance.
So what are the big benefits driving this? Why tokenize assets?
The benefits are genuinely transformative. First, enhanced liquidity. Think about assets like commercial real estate or private company shares, traditionally very hard to buy and sell quickly. Tokenization can turn them into easily tradable digital assets, unlocking potentially trillions in value.
Making illiquid assets liquid.
Exactly. Second, fractional ownership. You can divide a high-value asset, like that building, into thousands of small, affordable tokens. This democratizes access to investments previously only available to the wealthy. Third, operational efficiency and 247 markets. Transactions can settle peer-to-peer in minutes, 247, 365, compared to the days it takes in traditional markets, like the T+2 settlement cycle. And finally, programmable yield. You can bring the stable, predictable income from traditional assets, like the 4-5% yield from tokenized U.S. Treasury bonds, like Ondo's USDY, directly into the digital asset ecosystem and automate distributions via smart contracts.
So zooming out, this RWA tokenization has created something entirely new in finance then, isn't it? It's not just putting old assets in a new wrapper.
Precisely. It's creating what people are calling hybrid finance, or hi-fi. Early decentralized finance, DeFi, was mostly built on volatile crypto assets as collateral. Innovative, sure, but inherently risky. RWAs bring stable, yield-bearing, legally recognized assets into DeFi, tokenized T-bills, real estate. This provides a much more robust foundation of high-quality collateral. It de-risks the system and enables totally new financial products.
Like what, for example?
Well, imagine a small business tokenizing a piece of its commercial real estate and using that token as collateral to get a loan directly from a decentralized lending pool with everything governed by smart contracts. This fusion, the stability and scale of TradFi with the efficiency and programmability of DeFi, that's the frontier. RWAs are becoming the collateral of everything.
That's a fascinating evolution. And speaking of DeFi, how has it changed from those early kind of Wild West days? Is it maturing alongside this institutional interest?
Oh, absolutely. DeFi has definitely moved beyond that initial phase of, let's say, explosive and sometimes chaotic growth. We're now in a DeFi 2.0 era characterized by sophistication and integration.
So what are the key trends defining DeFi 2.0?
Several key things. First, as we've touched on, institutional adoption is massive. Big players entering the space demand more robust, scalable, and auditable infrastructure. This is pushing DeFi protocols towards higher security standards and better compliance practices.
Makes sense. Institutions need institutional-grade tech.
Exactly. Second, we're seeing the rise of DeFi, that's DeFi plus AI. Artificial intelligence is being used for things like smarter automated market making, real-time risk assessment for lending protocols, even predictive models for managing the assets held by a protocol. It reduces manual errors and makes DeFi more responsive.
Interesting. AI managing the robots.
Sort of, yeah. Third, there's a relentless focus now on user experience, UX interesting. Let's be honest, early DeFi was often incredibly complex to use. The new wave is all about simplifying interfaces, making onboarding smoother, creating mobile-first experiences. This is absolutely crucial for attracting mainstream users, especially in emerging markets.
Lowering that barrier to entry.
Precisely. And finally, back to our earlier point, cross-chain interoperability. It's not just important, it's a critical necessity for DeFi now. With liquidity fragmented across so many L1s and L2s, users need ways to easily move assets to find the best rates and services. Interoperability is key to unifying that liquidity and allowing DeFi apps to truly scale.
This sounds like a true maturation, moving way beyond just the crypto-native early adopters.
Right.
But let's shift gears to something really tangible outside finance. Supply chains. We hear promises of blockchain transparency there, but are there real-world examples where it's making a quantifiable difference today?
Yes, this is a perfect example of where blockchain is delivering tangible value in the physical world. Global supply chains are notoriously complex, often opaque, relying on fragmented paper trails. This leads to delays, inefficiencies, fraud.
A real mess sometimes.
Definitely. Blockchain offers a shared, immutable ledger where all the permissioned participants can record and view information, creating unprecedented transparency and traceability. And it's a booming market, projected to hit over $21 billion by 2029, growing incredibly fast.
Okay, so give us the concrete examples.
Let's look at two landmark cases. First, Walmart Food Trust. The problem was food traceability. Remember those scary E. coli outbreaks? Tracing the source used to be painfully slow and manual. Walmart did an internal test tracing a pack of mangoes back to the farm using traditional methods. It took them 6 days, 18 hours, and 26 minutes.
Nearly a week. That's insane when public health is at risk.
Exactly. So Walmart partnered with IBM on Hyperledger Fabric to create the IBM Food Trust. Everyone in the supply chain, farmer, processor, distributor, retailer, uploads data to this shared immutable blockchain ledger, end-to-end digital record.
And the result?
They ran that same mango traceability test using the blockchain system. The result? 2.2 seconds.
Wow. From almost a week to just over 2 seconds.
Incredible, right? This allows for surgical recalls pinpointing the exact bad batch instead of pulling everything. It protects consumers, massively reduces food waste, saves suppliers money. They've expanded it to over 25 products and even made it mandatory for suppliers of leafy greens. The key wasn't just the tech. It was Walmart using its clout to drive adoption.
That's an incredible impact. What about another industry needing trust, like diamonds? Conflict diamonds have been a huge issue.
Great question. And yes, De Beers Traker platform is another prime example. The problem: verifying the ethical origin of diamonds, proving they aren't conflict diamonds. Consumers demand it, regulators demand it, especially with recent things like the G7 ban on Russian diamonds.
Right, provenance is everything there.
So De Beers worked with Accenture to build Tracker. When a rough diamond is mined, it's scanned. Its unique physical characteristics, inclusions, flaws, create a kind of digital twin on the blockchain. This digital record follows the diamond through every step: cutting, polishing, selling. They use IoT scanners and AI matching to link the physical stone securely to its digital record.
Preventing swaps or fraud? What are the results?
As of 2025, they've registered over 3 million diamonds at the source on Track. The digital inventory track is worth over US $3.4 billion. It covers more than 2/3 of De Beers' production value. The value isn't just efficiency, it's ensuring market access by proving compliance with regulations like the G7 ban. It's boosting consumer trust, which is priceless in luxury goods. And it reduces the need for costly tests to detect synthetics.
Again, driven by a clear business need: compliance, trust, efficiency.
Exactly. And like Walmart, they face challenges, technical complexity, industry conservatism, but they're pushing it forward, even onboarding other miners to make it an industry standard.
These examples really bring the technology to life. Now let's talk about identity again. We touched on ZKPs and decentralized identity, but how is blockchain specifically giving individuals more control over their personal data with self-sovereign identity?
Right. Self-sovereign identity, SSI, is potentially one of the most impactful applications. For decades, our digital identities have been controlled by big companies and governments in centralized silos. Think Facebook login, Google accounts.
Leading to data breaches, lack of control.
Precisely. Massive breaches, users having little say over their data, constant re-entering of information. SSI flips the model. It's user-centric. Individuals control their own digital identity credentials in a secure, private digital wallet on their device.
How does that work? Who issues these credentials?
It involves 3 main roles. You have issuers, trusted organizations like a government issuing a digital driver's license, or a university issuing a digital diploma. These are cryptographically signed and verifiable. Then you have holders. That's you, the individual. You receive these credentials and store them in your digital wallet. You control who sees them and when. And finally, verifiers. Maybe a website needing age verification or an employer needing proof of a degree. You, the holder, present the necessary credential directly to the verifier. The original issuer isn't involved in every verification request.
And ZKPs play a role here too.
They're the magic ingredient. ZKPs let you prove just the specific piece of information needed. Yes, I am over 18, without revealing the full credential, like your entire driver's license data. Maximum privacy, minimum disclosure.
What are the benefits, especially for businesses?
Huge benefits. Streamlined compliance and reduced liability. Think about KYC/ML checks for banks. Instead of collecting and storing tons of sensitive customer data, a compliance nightmare and a target for hackers, they can just verify reusable credentials issued by trusted sources. Reports suggest this can cut onboarding costs by up to 70% and speed up verification by 90% in some cases.
Wow. And fraud.
Drastic fraud reduction. Because these credentials are cryptographically secure and verifiable, it's much harder to create fake identities or take over accounts. Financial institutions using SSI are reporting fraud reductions of 30–50% in areas like account opening.
What's noteworthy here is the enormous societal impact this could have beyond just business efficiency.
Oh, the societal impact is potentially enormous. Think about financial and social inclusion. The World Economic Forum is looking at decentralized ID to help the estimated 850 million people worldwide who lack any formal legal identity. Without ID, you're locked out of banking, healthcare, education. SSI could provide a secure, user-controlled way to establish identity and unlock access to these vital services.
That's incredible potential. What's next for SSI?
We'll likely see convergence with AI for more dynamic, risk-based authentication, and the rise of portable reputation, using verified credentials from one area, like your credit score, to access services in another, like renting an apartment, more easily.
So these real-world applications clearly show blockchain maturing and delivering value. But let's pull back to the bigger picture. Where does this tech stand in the broader market? And what about regulation? That always seems to be the elephant in the room.
It is a crucial piece, absolutely. And these advancements aren't happening in a vacuum. Market forces and, yes, evolving regulations are shaping everything. They're both driving growth and setting boundaries. And the market growth projections are, frankly, staggering. The global blockchain tech market. One forecast sees it surging from around USD 31 billion in 2024 to over USD 1.4 trillion by 2030. That's a CAGR of 90%.
1.4 trillion, that's astronomical growth.
It is. Another, perhaps more conservative forecast still puts it near USD 400 billion by 2032, a 43% CGR. Either way, we're talking explosive growth, driven by demand for secure, transparent, efficient processes across the board.
Where is this growth concentrated? Which sectors or areas?
Looking at the breakdown, by industry, finance, BFSI, is still dominant today, but healthcare is projected as the fastest growing segment, driven by secure patient data needs. By organization size, large enterprises led early on, but SMEs are expected to grow fastest now, partly thanks to easier access through blockchain-as-a-service platforms for things like payments and supply chain. By application, payments are big, but digital identity, as we just discussed, is expected to see the fastest growth. And regionally, North America led in 2024, but Asia-Pacific is projected to grow fastest, with strong government support in places like China, Japan, and India.
And are we seeing big strategic moves reflecting this growth?
Definitely. A really significant one was the acquisition of Securrency Inc., a digital asset infrastructure firm, by DTCC. DTCC is like the plumbing of the traditional financial system. Them buying, not just partnering with, but buying core digital asset tech. That's a landmark signal. Incumbents are integrating this stuff directly now. It's becoming core infrastructure.
That's a huge shift, moving from partnerships to ownership.
Right.
Okay, but regulation. You said the era of uncertainty is ending. What does this new clarity look like? Is everyone finally on the same page globally?
Well, the uncertainty is ending, which is crucial for growth. We're moving into an era of clear, comprehensive frameworks. That provides the stability institutions need. However, on the same page, not exactly. What's fascinating is seeing distinct strategic priorities emerge in how major economic blocs are regulating this space.
Okay, strategic divergence. How so? The U.S. versus Europe, for example.
Exactly. The United States seems to be fostering market-driven innovation, especially around stablecoins. The big piece of legislation is the Genius Act, passed mid-2025. It creates the first federal framework for payment stablecoins, mandating regulation, 100% reserves, AML KYC. This gives clarity to a massive market and encourages traditional finance players. The underlying strategy appears to be using private sector innovation to reinforce the global role of the U.S. dollar.
Okay, U.S. fostering private stablecoins. What about the EU?
The European Union has taken a much more comprehensive, centralized approach with MiCAR, Markets and Crypto Assets Regulation. It's the world's first major pan-block crypto rulebook. MiCAR applies pretty strict, almost bank-like rules to crypto service providers, focusing heavily on financial stability and consumer protection. Stablecoin issuers, for instance, basically have to be licensed like banks or e-money institutions. It clearly aims to assert EU control and pave the way for a potential digital euro CBDC.
So very different philosophies. What about elsewhere?
We're seeing Asia and the Middle East really competing to become crypto hubs. Places like Dubai with its VARA regulator, Hong Kong, Singapore, Japan, they're creating progressive, clear frameworks trying to attract innovation and capital.
But global consistency is still lacking.
Definitely. The FATF keeps pushing for global AML standards, like the Travel Rule for tracking crypto transactions, but a recent FATF report showed big gaps in how countries are actually implementing and enforcing these rules. So international coordination is still a work in progress.
Zooming out, it sounds like the U.S. and the EU are setting themselves up for potentially competing visions of the digital financial future. What are the geopolitical implications there for businesses operating globally?
That's a really crucial point. They aren't just adopting different styles, they're arguably creating competing digital currency strategies. The EU's MiCAR seems designed to create a tightly controlled, bank-centric ecosystem, limiting the influence of, say, US dollar stablecoins and preparing the ground for its own digital euro. It's about asserting economic sovereignty. The US, by contrast, with the Genius Act and less enthusiasm for a retail CBDC, seems focused on letting private USD stablecoins flourish under clear rules, effectively extending dollar dominance into the digital realm via the private sector. For multinational businesses, it means navigating potentially two quite distinct regulatory and monetary zones in the digital asset world, not one unified global market.
That's a critical strategic consideration. And alongside private stablecoins, we're hearing more and more about central bank digital currencies, CBDCs. How do they fit into this picture? Are they meant to replace cash or crypto?
CBDCs are definitely a huge parallel trend. A CBDC is a digital form of a country's fiat currency, a direct liability of the central bank itself. By 2025, many countries are deep into pilots or even launching them.
What's driving this big push for CBDCs?
Several key motivations. One is simply modernizing payment systems, making domestic and cross-border payments faster, cheaper, more resilient. Another is potentially enhancing monetary policy, giving central banks new tools. Promoting financial inclusion is often cited, offering digital payment access to the unbanked. And a big one is streamlining cross-border transactions, cutting the costs and delays of the old correspondent banking system.
So will they replace private money or crypto?
The general consensus seems to be no, not replace, but integrate. CBDCs are expected to coexist with cash, commercial bank money, and private digital assets like stablecoins and cryptocurrencies. The idea is they'll integrate with existing financial plumbing, hopefully fostering more interoperability between traditional finance and the digital asset world, not less. Think of it as another layer in the evolving monetary system.
We've explored the massive growth, the tech breakthroughs, the real-world uses, the regulatory shifts. It's clear this isn't just a niche thing anymore. But for you, the listener, as a business leader or just someone curious about the future, what's the practical takeaway? How do you move from just watching this to actually doing something?
Yeah, this is critical because, let's be honest, a lot of early blockchain projects failed. Not because the tech was bad, but because they were, a solution looking for a problem. The absolute key is starting with a clear, well-defined business case.
So how do you identify if blockchain is even the right solution?
You have to be rigorous. Blockchain is powerful, but it's also complex. Often a good old-fashioned database is better, faster, cheaper. You need a strategic decision framework. Ask yourself some tough questions.
Okay, like what?
First, is there a multi-party trust deficit? Does your process involve several organizations meeting to share info but lacking a single trusted intermediary? Think complex supply chains, multi-lender loans. Blockchain thrives where trust is low but collaboration is high. Second, do you need a shared immutable record? Is having a single, verifiable, tamper-proof source of truth absolutely essential for everyone involved? Like for proving provenance, settling trades, or compliance? If data needs frequent deletion, maybe not. Third, what's the role of intermediaries in automation? Does your current process rely on costly middlemen for verification or reconciliation? Can smart contracts automate agreements based on verifiable data like pay on delivery? And fourth, data governance network. Is the data suitable for sharing? What kind of network, private, public? And crucially, how will it be governed? Who makes the rules? Only if you get positive answers across these areas is blockchain likely to offer a significant advantage.
It's a really useful framework. So once you have identified a good use case, what's the practical roadmap? How do you implement it without getting bogged down?
The best practice is definitely a structured, phased approach. The mantra is start small, scale smart. Don't try to boil the ocean.
Okay, what are the steps?
Step 1. Identify a high-value use case and build the business case, maybe 2 to 5 weeks. Focus on a specific pain point, slow payments, fraud, whatever. Define clear objectives, KPIs, benchmark the current process, estimate ROI. Remember Walmart starting just with mangoes and pork?
Right. Focus pilot. Then what?
Step 2. Choose the right blockchain platform and consensus model, quick, maybe a week. For enterprises, often a private or consortium chain like Hyperledger Fabric, Corda, Quorum makes sense for control. Pick an efficient consensus like proof of authority if you have known validators. Step 3. Develop a proof of concept, POPs, or pilot. This takes longer, maybe 1-2 months. The goal isn't perfection, it's testing core assumptions, proving viability. Build an MVP that tackles the main pain point. Walmart's 2.2-second traceability result came from their pilot.
Proving the value quickly.
Exactly. Step 4. Analyze, refine, and plan for scale. About a month. Rigorously check pilot results against your KPIs. Refine the solution. Build the full business case for scaling up. Plan infrastructure, governance, partner onboarding. And finally, step 5. Integrate with existing systems and launch. This means connecting smoothly with your ERP, SCM systems via APIs. Comprehensive training is key. And remember, success hinges on user adoption.
That's a very clear, actionable roadmap. So wrapping up this deep dive, beyond the immediate implementation steps, what practical actions should businesses be taking right now to build for the future and really gain a competitive edge here?
Okay, several key strategic actions come to mind for staying ahead. First, invest in education and talent. This space is complex, skilled people are scarce. You need to upskill your current teams and actively recruit specialists, smart contract devs, cryptographers, architects. It's foundational.
Build that internal capability.
Absolutely. Second, engage in industry consortia. For many powerful use cases, supply chain, finance, identity, the value is created at the network level. Don't go it alone. Join or even help form consortia to shape standards and build those crucial network effects.
Collaboration is key.
Definitely. Third, and this is huge, lead with business, not IT. The most successful projects solve real business problems and are championed by the business units themselves. Articulate the vision in terms of outcomes. Cut traceability time from days to seconds, not tech jargon. IT enables. Business leads.
Makes sense. What else?
Fourth, develop a tokenization strategy. RWA tokenization is going to be massive. Start looking at your own balance sheet and operations now. What assets, physical, financial, intangible, like IP, could be tokenized to unlock liquidity, create new investment products, or streamline management? Getting your head around the legal and operational side now gives you a first-mover advantage.
Start thinking about what you own that could live on chain.
Exactly. And finally, monitor the regulatory landscape and prioritize compliance. The Wild West days are over. Stay on top of evolving rules like MiCAR in the EU, Genius Act in the US. Build robust AML KYC processes. Expect more scrutiny. Compliance isn't just a chore, it's table stakes for legitimacy and trust.
We've taken a deep dive into blockchain and cryptocurrency in 2025, moving beyond the hype to see a robust foundational technology really taking shape. We explored architectural innovations like modularity and ZKPs, witnessed tangible business value in RWA tokenization, supply chains, and digital identity, and navigated the evolving market and regulatory landscape. The key takeaway: the shift to a more decentralized economy isn't some far-off future, it's happening right now, being built by major institutions. Success hinges on a strategic, business-led approach, focusing on solving real problems and delivering measurable ROI. So here's a final thought for you to consider. If the core value proposition of blockchain is verifiable trust without intermediaries, what other areas of your life, maybe personal, maybe professional, are currently bottlenecked by lack of trust? And what might a truly decentralized solution look like there? It's not just about what blockchain is today, but what it unlocks and how we interact. Think about programmable trust for collective action, way beyond just finance. What could we build together when trust isn't a leap of faith, but closer to a mathematical certainty?